How we doing? How we doing? This is Destination Denver, Colorado, and today the brutal truth about the Denver housing market. Are we headed for a crash? Are we headed for a correction? We're here to talk about it, starting right now. Alright, this is Destination Denver, Colorado. I'm your host, Jimmy Everett, and listen, if you're interested in learning all the ins and outs, pros and cons to moving to Denver or the Front Range area, this is definitely the channel for you, and you're going to want to click that subscribe button. And as much as I try to be informative here on camera, I'm also a licensed mortgage broker, teamed up with some of the state's most talented realtors, and we are helping people move here each and every day. So the number and email you see on the screen, know that I'm always the person answering those phone calls, answering those texts, answering those emails. Now that we're done with that phone field stuff, let's get to what we're here for, and that is the brutal truth about the Denver housing market. All right, so because we're going to cover a lot of information, we're going to take it in three sections, and I just want to give you a very quick outline of what those three sections are. So first, we're going to talk about the current state of economics and how it's applying to the housing market, quick and easy. Next, we're going to talk about Denver and the Denver metro area, and again, how it applies, what is going on here. And third, towards the end, I'm going to give you 12 quick risks to buyers, sellers, the market as a whole, kind of some predictions, if you will. That's why we have the videos broken into chapters, so you can go to exactly what you want to hear, or you can listen to the entire thing. So having said that, the word of the last several weeks has been tariffs. And as of April 2nd, this being April 9th, tariffs were imposed by the United States. They started at roughly 10% across the board, with many nations being placed higher than that 10% number. Now, how does that affect housing? Well, home builders are predicting that it's going to increase the cost of their construction by roughly 9%. How much that will then be passed on to potential home buyers, we don't know yet, but we have that 9% number as a starting point. Now, at the same time these tariffs were put in place, we saw mortgage rates start to fluctuate. And initially, if you were looking short term, it looked like great news. Mortgage rates dropped the lowest they had been in about 3 months, and they sat at roughly 6.6% on average for a 30-year conventional loan. Just as quick as that happened, over about 48 hours, rates jumped right back up. They're closer to 7% on average for a conventional 30-year loan as of making this video. And the bottom line is that we continue to see rate fluctuation, the same we have seen over multiple years. This isn't actually new news. This was just actually one of those rare occasions where we could kind of point to a specific thing that impacted rates, as opposed to the guesswork that we've had to do again over those last 24 to 30 months. Now, all of this currently has left the Fed kind of guessing. The Fed was looking for inflation numbers to come down, looking to lower their short-term rates. That does eventually have some level of impact on mortgage rates, though not directly. But because tariffs tend to be inflationary, they're kind of at a standstill. They don't know what to do. This has left them really on unstable ground. So you kind of have different parts of the government, different parts of our economy, not necessarily on the same page at all. And we'll have to see which one, I can't even say takes charge, what decisions each makes. Bottom line to you is, because if the cost of building goes up and rates continue to fluctuate, you are not going to see a lot of homes enter the market. A lot of people who own homes and do not have to sell are most likely going to stay in those homes until more stability returns. Second big and interesting factor, boomers are back. So boomers had been replaced by millennials as the generation buying the most homes. Currently, boomers retook the lead. They are buying 42% of all homes currently. Now, obviously they are selling some of these houses as well to put them to market, but as of the making of this video, 4 out of 10 buyers are of the baby boomer, that is, generation. And why does this matter to most people? Well, a lot of baby boomers, because of the fact that they are selling a previous home, they don't need a mortgage. Now, why does this matter to you? Well, unless you are a baby boomer, baby boomers tend to sell a house in order to buy another. That means they tend to need a smaller mortgage or no mortgage at all. And that is, at the end of the day, your competition. So could be some bad news for other generations that so many baby boomers are in that buyer's market. All right, so let's talk about what is happening in the Denver market. And the data that I'm using for this video is specifically from the city of Denver. However, it applies, maybe not dollar for dollar, but it applies across the board of the Denver metro area, because you're gonna see a lot of similarities across the city. So first and foremost, the majority of homes being sold, no shock here, single family. Roughly 6 to 7 out of 10 homes are single family. And you see from these stats, single family home median price sitting at about $660,000. You see another 14 to 15% that are townhomes. Median price for a townhome sitting closer to $549,000. And then 21% of the homes being sold are condos. And a condo, $330,000. Why does this matter? That's a pretty big spread. The idea between whether you are going to buy that single family, whether you might take what you might call a step down, a townhome, or whether you might really be looking a lot of starter homes, are those condos. So you see that price point spread between them. And one of the more interesting things that you're going to see about markets is when you start to compare average home sales prices to median sales prices. Average sale price can really throw things off because of that luxury market that you see. So over the last 6 months, the average home price in the city of Denver, not as of today, I'm saying the average over the last 6 months was $734,000. The median home price during that same period of time was $570,000. And again, the reason you have that $164,000 gap is because you have these $2, $3, $5, $10 million homes selling, and that skews that average sales price. So let's talk about a common entry point to homes, and that is condos. And this isn't new. This is for people who are buying homes, this is people for renting homes, but from a purchase standpoint, condos usually represent about a 42% discount from townhome and single family homes in price point. And even townhomes, again, are roughly 17% on average cheaper than a single family home. And I know a lot of people, the second they hear that, they say, no, I don't want a condo, I don't want a townhome, I don't want an HOA. Well, here's the thing, and there are certainly some negatives to HOAs that we're gonna cover, but the fact that these units have an HOA are part of the reason that they are sold at a discount price. It's part of the reason that you might be able to buy them in the first place. And looking at HOAs and the impact that they have, and not necessarily to say that just because a property has an HOA affects its price point. I mean, certainly the home itself, what type of house, has a big characteristic. But when you take a look at HOA properties, the median price for those was $452,500. The median price for a non-HOA home was $650,000. So you're talking about nearly a $200,000 spread. So you're talking about properties with a median price point, $200,000 cheaper because they had an HOA as opposed to not having an HOA. I don't know about you, maybe it makes you look at an HOA that's reasonable a little differently. And let's talk about the premium on size, like getting more bang for your buck, just to give you an idea of how much these things cost. Because I talk to people all the time who say, whether they're again renting or buying, I need this many bedrooms, I need this many bathrooms. So as far as this data over these last 6 months, a bedroom on average costs you between $150,000 to $200,000. An extra bathroom in a house costs you, as far as price point, an extra $150,000 to $300,000 for an extra bathroom. And you're going to see some of that applied to rent as well. So if you can deal with 1 bedroom or 2 bedrooms as opposed to 3 or 4, if you can deal with 1 to 2 bathrooms as opposed to 3 to 4, it's going to save you a ton of money. Now again, that is depending on your situation, depending on your lifestyle, depending on what you can afford. But buying more than you need, that 3rd bathroom you're never going to use or that 4th bedroom that you're never going to fill with furniture could save you a ton of money and could put you in a better position. And the differences that you're going to see in price per square foot. And this obviously depends on where you're coming from, and it depends on where you're gonna buy here. Because you can find properties, again, throughout the Denver Metro, where you get down to a price point of $74 a square foot, or you could be all the way up to $1,922 per square foot for some of these listings that sold. Now, obviously, that was a luxury listing. Let's just be clear on that. But that's how big a spread you might be talking. So where is demand heading? Well, as we talked about, a lot of that demand is heading towards condos. It's heading towards townhomes because that's where a lot of that affordability is as long as the HOA is reasonable. And that's not just first-time home buyers, that's downsizers as well. That is people such as those baby boomers who have decided that they don't want that 4-bedroom, 4-bath, big old house with a huge yard. They want to move into a condo or a townhome. They want to move into something that they don't have to maintain as much as their current house. And these outlying areas, people, again, this data might have been about the city of Denver, but this is applying to these suburbs. People are getting out to the outskirts of Aurora, the outskirts of Lakewood, Littleton. They're getting farther into the suburbs for some of this. And that affordability waves. As people want to leave the city and as people want to move back in, you might have slight fluctuations in those price points in different communities. And I'll admit to you, if you're looking to buy a house, expect to have a lot of competition if you are looking below $500,000. And that almost makes me want to throw up in my mouth. I remember moving back to Denver around 2008, 2009 and saying to myself, part of the reason I'm moving here from New York is I don't want to pay $500,000 for a home. But 17 years later, here we are. So very quickly, strategies for some folks or some thoughts. If you're a buyer, one, prepare for the worst. Strategize to win. Here's what I would tell my own cousin. I'd say budget for the total cost of home ownership. Be aware of taxes, maintenance, HOA dues. Don't assume that your income is going to increase. Don't assume that rates are going to go down. Plan conservatively. And yes, for the right condo, for the right townhome, you might look at that as a long-term option, a little more than a stepping stone. This is not the market where you're going to buy something and odds are be able to sell it and move on 2 to 3 years from now. You need to look at a longer window, probably 5 years or greater. And if you need 4 bedrooms, accept the fact that you are probably in what we would say a luxury market. You're looking $750,000 or more in most of the quality communities you might want to live in. And for sellers, forgive me, you can't be delusional. If you bought, especially for those folks that bought in the midst of 2020, 2021, the folks that don't have a lot of equity, first and foremost, we're not seeing a ton of inventory come to market. We see buyers being pickier about the homes they buy. And we see that if homes are not priced right, they sit and sit and sit. And not for weeks, for months. So in this market, greed is not being rewarded at all. The last bit of strategy I would give is a little mindset over mayhem. This isn't 2008. This isn't a crash. This is a recalibration. Even in a recession, let's be very clear. Most people, the majority of people, maintain their jobs. And a lot of those people buy and sell homes. So we might be in for rough waters, but there are still going to be opportunities for those who look for them. At the end of the day, housing is always cyclical. As some people are moving on, other people are trying to plant roots. Now, I can't leave you here after all this information, again, with tariffs throwing things off and different risks to the market. Can't leave you without talking about the risks that could occur to buyers, sellers, and the system as a whole. So for buyers, biggest risk to me is rate whiplash. And that is this idea, again, as I've talked about, that they go up and they go down, they get up, and it just exhausts you. It just pounds you into the pavement and you no longer want to even look at the market. And no, you are not going to time it. Literally, the difference between someone buying a house and locking their rate on Thursday, it would be April 4th, and today was, say, 6.6% to 7%. There's no timing it. Second, affordability is not returning. It's receding. That means that if you're waiting for Denver to become affordable again, you might be waiting forever. Prices aren't crashing, they're stalling at high altitude. They're up here and they just can't come down. The pandemic increased them to a point where, as much as we'd like to see them just settle and become more affordable, it's not happening. The equity mirage. If you stretch to buy now without fully understanding the cost of home ownership, taxes, insurance, those HOAs we talked about, you could put yourself in a really tricky situation. And when we're talking about these condos and HOAs, when I talk to you about a good condo, a good townhome, a good HOA, something we take a long look at, and a bad HOA is crucial. Entry-level buyers are being funneled into these condos, and a lot of them have high HOAs and they have aging infrastructure. And if your HOA in one of these buildings goes belly up and they hit you with a $30,000 special assessment, think about the devastation that would cause to you. So all of a sudden, this $330,000 condo becomes a financial tombstone. That's the last thing we want to happen. So if condos and townhomes are of interest to you, you're gonna make sure you have the right team, making sure that those financials are in line. What are the risks to sellers? Well, you have pandemic pricing hangover. You have people that think their home is still going to sell in 2 seconds, that you just throw it on the market, throw a sign out, and you're good. That's not the case. If your house is not priced, and I'm a lender, I don't make money off of anybody selling their house, but if your house is not priced correctly, no one is going to buy it. Not in this market. Second, then you have your equity rich and liquidity poor folks. So, you're short on a little cash, but your Z estimate says that you have $200,000 in equity, and that's great. It says it's there, but unless you sell, you can't get access to that money, and selling would just drive your price point forward. So get excited about the Z estimate, get excited about the equity you're building, but understand that's still the long term. And I will implore all of you, if you have especially a pandemic era or earlier lower rate, if you're in the 3s, 4s, I don't care what anybody says, do not refinance that rate. Do not do a cash out of any sort. If you need a HELOC, get a HELOC, but don't touch that loan. And having said that, the refi prison is also real. I understand that if you purchase a house, or refi a house, and all of a sudden you're sitting in this house, you've got a 2.8% interest rate. Now your family's getting bigger, you got to move, you got to do something. And now all of a sudden you're going from 2.8 to an interest rate of 6.5, and your mortgage payment is doubling. That's a lot of pressure. That is the risk that a seller has right now, that they have a mortgage payment that if they make any type of move, they will never be able to replicate. Now, what's the systematic risks that are happening here in Denver? Well, first and foremost, there's no middle. So you have these luxury homes, you have a lot of entry-level homes, but for the middle, for the people who are maybe looking for a small step up, for the people who are looking for a smaller step down or downsize, there's not a lot in that middle. The Denver market is really barbell shaped in that way. And that running nightmare we have is that missing 450,000 to 550,000 single family home. Next, we got stagnant inventory and really no assistance in sight. So when you have tariffs and you have labor shortages and you have a lot of municipal red tape, which exists in Colorado and probably in your state as well, that leads to a chokehold on new builds. So prices stay elevated while selection gets worse, and it's a supply and demand logjam that just can't move. And let's be very clear, there's no quick political fix to unclog it. And last, and as I mentioned earlier, rate sensitivity is breaking the housing market. So the Fed is still fighting inflation. One wrong move by the Fed, one wrong move in one of these tariffs, interest rates jump back over 7%. Again, they make one move, they come down below 7, they start looking like they're gonna get closer to 6. Then one wrong move, they jump right back up. The Denver market or real estate across the country cannot sustain with that type of fluctuation. It's amazing that we've managed to hold on for as long as we have, going on 3 years of this. So at some point, if that continues and you're seeing it gradually, sellers will stay put, they'll freeze. Buyers will bail out of thinking about purchasing a home, and the entire machine slows to a crawl. I want you to think overall like this housing market is a huge game of Jenga. It's sitting on blocks. And different sellers and different buyers are pulling out blocks. The US government pulling out blocks. The Fed doing its thing. And this thing, man, it's getting a little shaky and a little unstable. But let's be very clear. It's not a situation where the thing is going to crash. Everyone wants to bring up crash. The bottom line, too many people have low rates on their house. Too many people have a ton of equity in their home. Too many people have fixed interest rates, thankfully. These are all thankful things. Too many people have fixed interest rates. They know what their payment's going to be. You're not gonna have these huge leaps and jumps like you did in 2008. You don't see fast rising unemployment numbers. There are just too many things that strengthen the housing market and the ability for home prices to remain steady, which in the long term is good. Gradual decrease and a correction might be beneficial. Obviously, crash not, even if you think it is. But we are, to some extent, a bad jobs report, a bad inflation report from this Jenga tower getting a little more shaky. And what that means is, again, not a crash, but certainly, perhaps in certain areas, a sizable correction. But look, this market is not getting easier. It is filled with challenges, and that's why we're here to inform. And listen, you ever have any questions, I don't care what state you're in. I don't care if you're thinking about a loan at all. That's not what I talk to everybody about. If you have any questions ever, that's why my phone number, my email are here. Know that I'm always the person, answer phone calls, answer your texts, answer emails. There, winning if you need me. This is Destination Denver, Colorado. That was the brutal truth about the Denver housing market. Will we see a crash? Will we see a correction? Time will tell. Until I see you next time, peace.